Welcome to another weekly market insight. I'm actually in Tampa this week, left Naples, and I'm actually happy that the weather is not only more beautiful than it is in St. Louis, but it's more beautiful than it is in Naples. It was actually a cold week for us last week. I'm in a Lifetime, so if there's some background noise, but it's better internet connection than where we were at, and maybe we won't have blenders coming in on this one on this time. But I promise you, Tampa is absolutely beautiful, and I was hoping to get Tampa Bay in the background, but the light was it just didn't work. But joining me this week is Chris. You're still in St. Louis. I heard that there was a little bit of snow last week. Is that right?
A little bit. It's all gone by now, but
That's
hopefully I'm looking better too with some real lighting on me here. So,
well, it's definitely towards the end of the winter with you on that lighting. You need to get back down here to Tampa so you get a little bit of color to you.
Yeah, I agree.
You were pointing out though, I don't look too burnt, and that's because I wear a hat. As you bald, if you go through that, you'll know to always wear a hat. But let's just jump into it. Let's go down to our slide where we talk about the themes. Inflation risk is high. That's something that we have said would be the case, and the Fed had said otherwise. They were using the word transitory, and we were correct. I don't know that we'll be invited to the minutes coming up, but we certainly have been correct, and the Fed is starting to acknowledge it. We're going to get into that and spend some time on the CPI, some rates, and really some comments from probably the most hawkish Fed member this week with Bullard. So jumping down to price points, we can start to see the movement in the market. Is there really anything concerning here for you, Chris?
Well, we did see yesterday, we did make a higher low, and today there was some volatility. So that higher low came in at 4,400, but we've really created a double top at that 4,600. So that's really our resistance level. But it's really not surprising to us, kind of given what's been going on. There's been a lot of Fed speak, like you said, and probably the big headline is geopolitics. And so I really wanted to kick it off with a question to you, to understanding how we view geopolitics, because it's really easy to understand the initial part right there. Energy prices are going to be volatile from this, but how does this really affect the rest of the market?
Well, with this specific example, with the conflict in Ukraine and the possibility of going into a hot war, the energy prices, Europe is very dependent upon the natural gas out of Russia, and that pipeline comes straight through Ukraine. So there is the energy concerns there, and they're already short on. They're already having shortages, and we've been shipping natural gas via ships there. So that's already problematic for the energy scene. But if we were to go to a hot war, especially with the combatants and the belligerents that would be involved, there's going to be a lot of energy use. And energy is kind of a tax within the system. No matter what you're doing, you have to ship something to get it somewhere. There's an enormous amount of sand down here in Tampa and in Florida. But then the cost of getting that sand, which is just abundant anywhere, is all going to be energy costs. So if we were to have a hot war, yes, the energy prices are going to move up, but that also is going to be put into the price of everything else, because everything else is so dependent upon transportation. And then with these two types of very large militaries consuming, it's going to have an effect across the overall economy, just because the amount of resources that would be needed for those for any type of hot war. I tell you, it doesn't really look like that. I know the Biden administration has pushed that this is imminent, and that they certainly have better information than I do. But the market doesn't seem to really have it at the volume level that the Biden administration has it at. Ukraine, the business people continue to move around. There's not a big drop in the currency. Markets are certainly aware of the situation, but it doesn't seem to be responding as if it is imminent that there is an actual hot conflict there. And hopefully cooler heads prevail. I think this is a little bit more of kind of distracting us from some of the other things that inflation number specifically. That's kind of what I think is actually happening there.
That makes sense. In our next slides, we'll probably get into a little more inflation. May as well kick it off with this first slide here, which is really the MOVE index, which we talked about the VIX a couple of weeks ago, which is volatility for the S&P 500. The MOVE index is volatility for treasuries. And it's at the highest level we've seen in a couple of years. So The bond's been pretty volatile, and they've been selling off with rates moving up this past week on high inflation. But they did retreat a little bit. That safety trade is what happened when you get some of that geopolitics. Treasuries were bought along with gold. Gold was up 2% or so off the Russia-Ukraine news. But volatility is here, and it's in bond prices as well.
Yeah, and I would point out that volatility hasn't been this high since March of 2020. But the volatility, because it's just measuring the price movement, not whether it's up or down. Right during the March 2020, that was a different type of rate movement than what we're seeing here, and is also the hawkish Fed comments from Bullard, and then also the emphasis on a possible conflict in Europe is that jawboning. Really trying to cool down some of the amount of inflation that we have. It's hard to tell and separate those out. But as you're pointing out, the volatility is very high in rates, and it's been showing up in the yield curve. You want to move to that slide?
Yeah, in the yield curve, what we were showing here is the yield curve across all maturities from a year ago, 6 months ago, last week, and then the most recent close. And the trend has been across the board, rates up. Even over the last week was more of a parallel shift, but overall, since 6 months ago, we've been seeing more of that inflation baked in on the shorter end of the curve. That's why you get that big bow in the middle moving up higher, and then flattening out towards the end.
And I find this a little bit more healthy than the previous yield curve. You can make arguments that this is a flat curve, that there's not much delta between the 30-year and the 3-year, but I like to think about it as banks loaning money. So right now we have fiscal monetary policy. I like to combine those two just because they seem to be so connected. It's not necessarily tax policy anymore. It's all about just deficit spending. So it requires monetary policy. But I thinking of it as banks, you're going to focus on the very short end of the curve because they're borrowing money from their depositors, and then they're going to lend long. So let's say whenever we were looking at that yellow-green line, you're not going to loan a lot of money in that 3-year to 7-year as depositors. You're going to be looking to make mortgage loans at 30 years out because that's the biggest spread that you can make between the two. To see that 3-year and that 7-year, which is a lot of corporate financing, moving up where now it's profitable loan out at that, we could actually move out of the central bank being the only player within the amount of money that's being created, and the banks begin to create and loan out, which could continue on the inflation component, which is something that the Fed is probably very aware of, and maybe that's why Bullard is making his comments. Want to jump into Bullard's comments?
I just wanted to close out one thing on the curve, and that is something we're going to hear a lot about, and we'll be talking about is the balance sheet runoff that's coming on. Bullard did make comments that he wants to start that a lot sooner, which is, the Fed holds all these treasuries and a lot of them are maturing soon. And as those mature, they can shrink the money supply and force Treasury to then roll those bonds forward, putting some more pressure on the longer end, raising rates. So it's a way they think that the yield curve can steepen a little bit, and that's favorable for what you said, which is, banks loaning money. So that's something
and that's like the issue of like controlling it. Yes, we have a lot of money that's been created, but if your argument is you're going to drain the money, which is prudent, but then your movements are going to cause the banks to begin to expand the money supply at the same time. It's really hard to see exactly how this is going to play out, and that's why we're going to have to be data dependent for this whole thing.
So what's been happening with Bullard? We got a couple rough headlines here on the slide, just showing he's been moving markets pretty significantly just by saying some of these comments, making the rounds too. He's not turning down an interview right now.
No, he's not. And being a local guy here in St. Louis, he's one of the ones that we can access whenever he's doing speaking events. So, I'm a fan of him. I like him. I think he's got a pretty good understanding relative to some other bankers. I think he knows and understands economics very, very well. But he also understands the politics of things. And I think that's what's actually happening here is he wants to be chairman. And it's my own armchair psychology here is I think he wants to move into that spot and remove Powell, and coming out being hawkish while inflation's high. And he did this while he wasn't even a voting member. it really makes him look like he's got a great crystal ball and he understands the economy much better. And if he's wrong, it doesn't hurt him politically because the Fed then moves on and they don't do anything. But if inflation remains high and he was the one being the Cassandra, then he's certainly going to increase his odds, I think, to be chairman. And I think that's a lot of what's driving his comments at the moment. I would say, like Powell, he came in and he said he was going to follow the Taylor rule and he was going to be very data dependent. He wasn't going to move the interest rates based off of kind of the consensus is just going to be very formulaic. And that worked until about 2018. And the market started getting jittery. Taylor rule said keep going up. But we had President Trump's tweets saying that it needed to go the other way, and Powell went with the tweets, I guess. So who knows what Bullard would actually do if he was sitting in the chair.
Right. And his comments, but along with some more inflation numbers, obviously is probably the larger change, have changed the Fed fund future expectations for where rates are going to be, the Fed fund rate at the next March meeting. So if we look at this chart here, it's about a 60% chance that there will be rates at a 2 increase, so up to 50 basis points at the 75 basis point range at the next March meeting, which if we look at a week ago, that was only a 25% chance. And a month ago, the market was almost not even pricing that in at all. There's just about a 3% chance. So things have moved pretty quickly, expecting 50 basis points. I don't think either of us expect a 50 basis point move, even though it's about 60-40. I think they're going to be moving slower than what the market's actually expecting.
We're talking about Bullard and only Bullard, really. Everyone else seems to, he doesn't make the decision on that. So I would be surprised to see 2 rate hikes or a 50 base increase. Maybe if they're getting, but I think it's more about jawboning and trying to scare and spook the market into just automatically changing the rates to where they want it to be, as in they're going to change the actual Fed fund window rate. So I agree with you. I'm not surprised that there's an increased likelihood because that's what Bullard is trying to do, right? He's trying to make the market think that the probability of raising rates to kind of restore some credibility in the Fed. So it's not surprising to see a probability increase, but in actuality, I don't think we're going to see that high.
Credibility and messaging, right? The effect of a 50 basis point increase versus a 25 basis points increase is pretty small, but it's just signaling for what else is to come. Like we're serious about fighting inflation this time.
No, serious. We're serious.
We're serious this time. Yeah. So it gets us into the inflation number.
Sure.
Came in pretty high.
Yeah.
7.5% year over year.
Is that high?
It's a little high.
Yeah, I guess you're not making that in bonds, right? Nowhere near that actually over the last 12 months. No. And that's one of the reasons that we've continued to favor equities over fixed income is just because you're losing purchasing power. Fixed income acts as a ballast here. I know we're getting questions from clients on what we're doing to protect them, and we will continue to monitor, because the best way to beat inflation is to have higher rates of return than inflation, and we continue to move money to that. But as you pointed out, we continue to see that core and that headline CPI go up. I think we'll actually see it elevated for the next, pretty much the first half of 2022. Making sure I'm in the right year. COVID's messed up. It wasn't last year, 2019. But it's a 12-month look back. And the numbers, if we want to jump into that slide, we can see expectations and just see that they were elevated. And it's going to take a little bit of time to get those to drop off.
Yeah. So on this slide, and speaking of inflation hedges, if we actually, I don't have a slide showing this, but if we actually look back to that tallest blue number, that core CPI from last April, that's really when the first big shock came in of, almost a 0.9 on the month, I believe. If you look from then till now, traditional inflation hedges, gold or tips, they haven't really, the return's basically zero. So even though we've had this elevated inflation for some time, some of these traditional inflation hedges have not really worked. a lot of reasons why that could be, forecasting future, whether the price people actually were expecting inflation to be this high, even though everyone's saying they weren't expecting it to be that high and it was already baked into the price. But the other thing to point out here is that moderating in inflation last year, July, August, and September, that was a head fake. I was faked out by it. I know you weren't. So I just want to make sure, give you credit there. And I think that's what the forecast is going to be again for this year in 2022, is we're expecting consensus is for those to start moderating around that time again.
Yeah, I think second half we'll start to see that really drop off, and especially when we get out to July, where you have July, August, September, and if we have some moderate numbers going forward, you would still have April, May, June built into that headline. You're kind of losing some of those numbers. So I would expect June, July, August. That's whenever we start to see a cooling of that CPI. But if we look under the hood and we can see what's driving in used cars, really what we're saying is semiconductors, right? It's all about the chips, and they're not able to produce a lot of vehicles. And then you throw in the geopolitics with the Ambassador Bridge in between Detroit and Canada. What's that, Windsor, across the river? There are a lot of car parts that move back and forth. All of these continue to put prices, and used cars have really come in there. And I've seen some price increases on the top models where we can see it. They're mainly low end models, as people are trying to just get cars that are affordable. But at some point, this is going to clear, and that's going to help that CPI number. And I think we're getting close to that. And we're going to look at some numbers on shipping and supply chains. But one thing I would point out, so I'm being optimistic about supply chains, is that I don't think prices are actually high enough at the moment with these supply chain disruptions, because down in Naples, the local news channel was talking about how there was a shortage of flowers on Valentine's Day. Well, that shortage means the prices were not high enough. I know a lot of people don't like to hear prices are not high enough, because they certainly are higher than what we're used to. But if we're not getting a shortage, that means supply isn't able to meet the current price, and you either need to increase the price or you need to increase supply. And let's hope that it's an increase in supply. And then there is one number that I think is artificially low and will remain artificially low, and we've talked about that. That's that shelter for CPI, that it's rents equivalent. We've seen a little bit of movement on that, on what people would report they would rent their house out. But if we were actually looking at prices of homes, the CPI would be much higher than what it has been.
Yeah, 4% gain on shelter is on a 12-month change. It's laughable.
Right.
Maybe we'll see that one going up, and used cars and trucks coming down. Yeah.
So then, go ahead.
I was just gonna say, looking at the ocean freight that we discussed, and two of the big ocean freight players, Maersk and DSV, did report earnings, and they're in line. They're still sticking with the consensus that second half of this year is when they're going to start seeing improvements on some of those supply bottlenecks. But as far as the data, it's, kind of could go either way. If you're saying, is it improving? So if we're looking at just reliability staying on schedule, that yellow line is 2020. You can see it decreasing significantly. And then into 2021, there was some improvement at the beginning of the year, and then really kind of just petered out. So but in terms of days, shipping days delayed over the last few months, we have seen that come down, by about a day. Improvement,
It is an improvement. I think I think we're past the peak, barring, let's say, China closing more cities because of the Omicron or whatever new variant is out there. That's possible. They are hosting the Olympics right now, so who knows what could happen. But it seems that the supply chains are beginning to open up. There's a lot of backlog to work through, but I think we've seen the peak of that, and that's going to help if we get this start going the other way. That reliability to increase, some chips coming back, and these supply chains opening up. Obviously, the geopolitics that we started off with in Ukraine, if there's a hot war in Europe, that can absolutely disrupt this. But it seems that the cause of this, which was the COVID variants and the COVID virus, that's beginning to really show improvement, and the supply chains are starting to slow. And in addition to that, the amount of money that was created by the United States government to get us through that pandemic really put a lot of demand on imports. So if we're not doing as much stimulus anymore, that should also reduce some of that. But we've seen a lot of retail movement and sales in January. So then that gets us to PPI on another inflation component. It certainly is hot as well. Now I don't like to say that that companies get to dictate prices. It's really a consumer, but they do pull it up, and those inputs do actually affect the consumer price. It's just the consumers are pulling that stuff away. It's not so much as they're pushing those prices on the consumers. But I do think this is a good leading indicator of the CPI. But I also think it'll begin to moderate as well. What are your thoughts?
Yeah, I completely agree with you. 9.7% on a 12-month rolling PPI. I do think we're likely to peak out there.
So then, what is that doing to earnings though for the S&P 500?
So that earnings have been not really a change since last week when we reported them. But if we look at companies citing inflation on the earnings calls, you can see it's the highest it's ever been at 73%. And the bar is gray just because there's still 100 companies to report on the S&P 500. But the percentage, it's going to be a new record on companies citing inflation. And if we look at the effect on profit margins, still really to be determined. But as far as analysts baking it into their opinions and their expectations, they haven't changed much. So we have the dark blue is today, and the gray line is the end of the year, so this last month, where we've seen these hot inflation and PPI numbers. And the change on the S&P 500, which is in the right center of this, has only been 10 basis points. So they expect margins to only decrease by 10 bips since these their last reports. So it's really not working its way into the analysts' expectations yet as a significant change. So hard to say how you want to view that, right? It could be bearish if margins go down more than expected.
So then to kind of summarize our call, and inflation continues to remain hot. We think it will stay elevated until the second half, and then we'll begin to finally see that, barring any additional stimulus or anything that the Fed changes from its stance. The more aggressive that they are on reducing their balance sheet, raising rates, obviously the quicker that CPI will begin to come down. Getting a lot of calls about what to do about inflation. Once again, we have been overweight equities relative to fixed income for quite some time, and that's proven a good strategy for the last couple of years, especially as people want to go to those perceived safety and fixed income. Then also Buller's comments, probably more to do with politics than it is the Fed, and also the ability to jawbone and bring some credibility to the Fed. They have to get ahead of this inflation. But if they were to raise rates quickly, that could kill the current bull market. So they're going to try to jawbone that instead, where they use the market movement instead of their raising rates, so they can be accommodative, but also cause some concern and uncertainty in the market and keep prices down that way. And if you are catching us on YouTube and you haven't subscribed and reached out to get on our text message so that you can get the live call, please reach out to us here on the information here, and we'll add it to that text so that you can get the live link where we go into some of the other details in the portfolio. If you enjoyed the call, go ahead and hit like. If you think we were right on the inflation, and the Fed has dropped the ball on and should have been doing it quicker, hit that like button. Always please share that information by clicking that share. And if you haven't subscribed yet, hit that subscribe button. We appreciate everyone tuning in. You have anything in before we sign out, Chris?
Are you coming back next week?
I am going to be back. I'll be, I don't know if I told you, I'll be skiing at the end of March. So hopefully we can figure out how to do another Zoom where.
Do they have lifetimes out there?
I'm sure they do, but we'll be on the I think we'll be on the ski slopes. I think we'll be in Breckenridge. So hopefully inflation cools down by then, because that's not always the cheapest vacation. All right. Well,
Good.
thanks for tuning in, and we look forward to having another call next week. And we won't be talking about inflation, we hope. So see you next week.